So, okay, it's 12:01. I just want to thank everyone for joining us today. This is probably one of our most important calls. We appreciate all our research guys on it for our top picks model. And it's something that I actually use personally as well too. So well worth a call and a listen. And Rob, let's pass it over to you. I'm going to be muting myself and you're on.
Okay, thank you, Scott, and thank you everyone for tuning in. We were discussing earlier, jumping into the top pick portfolio. It is with regret that the top pick portfolio underperformed. It was a challenging fourth quarter. We saw a decline of 4.3%, as you can see on the screen here, trailing the TSX small cap gain of 3 and the TSX gain of 6.5. As an analyst, whenever we underperform, we have reasons why. If we were to point to one consideration, it's that the TSX small cap index itself benefited from 185% gain in oil and gas last year. So oil and gas represented 22% of that index upon its exit. So that is an area where we were clearly lacking in our representation, and it hurt our performance. We can still turn to a very good year in terms of 2021 for the year as a whole, gaining 19.4% for your return. In terms of our 3-year and 5-year numbers, still stellar, ahead 207 and 331%. In terms of the key names on the quarter, Pan Global, it led our portfolio. This name is thanks to Ryan. Did a very good job here, gaining 33% on a quarter. Ryan can talk to that. We highlighted that Dave Crystal did extremely well with 2 real estate holdings, Killam and BSR. It had 11.9 and 12.2%. Cannabis did represent a drain for us, but it's one of those where on an absolute basis, there were declines, but in terms of measured on a relative basis, Andrew's picks were exceptional, significantly outpacing his peer performance within that space. We would also note that, my submission with CloudMD represented a drain of 23.5% the quarter. That is one where we remain confident and call for a turnaround. You might notice that CloudMD is not in our top pick portfolio for Q1. And that is a matter of until this morning, we were restricted on CloudMD and therefore not able to put it in the portfolio. This has happened to us in the past, and as soon as the names did come off, they were submitted into the portfolio. That might be something to look for with respect to CloudMD. You will note that the vote by MindBeacon shareholders was completed yesterday. They voted 98% in favor of the CloudMD acquisition going through. So that is something that we will see finally announced with formal conclusion on Friday. It's an acquisition that we view very positively in terms of the strategy and the accretion associated with that. And CloudMD remains a name where we are very bullish. Don't want to take too long on CloudMD, but we want to give you one case in point that reflects the growth of CloudMD and the strategic fit of MindBeacon. CloudMD announced on November the 29th that they had won a long-term deal with Sun Life for a functionality called their Mental Wellness Navigator. And that means that Sun Life, who has 3 million benefactors of employee health programs, where those benefactors elect to take the mental health component and the navigator, CloudMD will be paid a certain amount per employee per month for that navigator function. So if Sun Life has 3 million benefactors, if 1 million of those were to take the mental wellness navigator, you could submit, it was $1 per month per employee or $12 annually, times that 1 million is 12 million. The service itself is provided by by artificial intelligence and by healthcare providers, i.e. not doctors. So one would submit that you probably have a 40% margin on that business. That's the direct gain. The navigator then directs the employee towards the most appropriate care provider. As it happens, MindBeacon is a mental wellness provider to Sun Life. So you will very well have a situation where an employee at company X calls into the navigator directs them to MindBeacon. CloudMD gets paid up here for the navigator functionality. MindBeacon, or now CloudMD, gets paid over here for the service functionality. MindBeacon has been recognized for the strength of its service capabilities. It has also been penalized in the marketplace for the high cost of user acquisition as an independent. We would submit that where the navigator refers the employee to MindBeacon, it's at paid for cost of acquisition. So the interesting thing behind this acquisition is MindBeacon brings a comprehensive full spectrum functionality across mental wellness to CloudMD, and this deal warrants strong support. But we will have more on that. I want to jump into the first name that we do have in the portfolio. This is a name known to most on the call, Converge. And with respect to Converge, the key things to consider would be organic growth and inorganic growth. The company announced an acquisition just yesterday, and it is true to form. And they've done 25 of these deals since Q3 of 2017. True to form in that non-competitive and accretive. So they pay 5.8 times EV to EBITDA. They realize reduced cost of goods because they have vendor leverage. They pull working capital out of the acquired company because they pay their payables on 80 days versus 40 for the acquired company. And then they do cross-revenue synergies. So it's a very typical deal for the company. We expect one in Germany in Q1. We expect one more in the US in Q1. So we see a number at depth of that pipeline that remains very robust. One of the overhangs on the stock has been the potential for supply chain constraints. They're there, they are real, but as a tracking measure, investors are looking at bookings plus revenues. If you go to bookings, which are contracted sales where they cannot deliver, plus revenues, they continue at a record pace, supporting organic growth of 10% plus to revenues and 15% to profits. So looking into 2022, we see catalysts in about continued acquisitions, organic growth, and we look for a listing on the London Exchange, probably in the third quarter as a catalyst. Our other name in the portfolio is also a returning name, and that is Quisitive. You can buy it for roughly $1.15, which is modestly below the valuation we would give to their IT services component. This is their legacy business. The one thing with Quisitive is they are very, very closely aligned with Microsoft. If you go to Quisitive for a solution, it will be Microsoft. They are a Microsoft or Azure shop. That means that Microsoft sends acquisition targets to Quisitive. That means also they get the full support of Microsoft in building out that IT services component. That is your underpinning of value there, as we have the IT services itself at $1.36. We're really drawn to the optionality here in that Quisitive has had a skunkworks project where they brought in talent, gave them stock in a subsidiary called LedgerPay. That LedgerPay has built an end-to-end payment processing solution that they will be rolling out. They just need final approval by Visa and MasterCard, and then they will be fully commercial and ready to go with full end-to-end payment processing capability. Key here is 9 out of 10 merchants think they're being given a bad deal by their payment processor. Probably 7 out of 10 are getting a bad deal. So LedgerPay is going out with a cloud topology, a fully digital end-to-end network with superior point of sale data analytics that will be an industry disruptor. This is your real wild card. This also plays into the company's strategy of buying what's called independent sales organizations, or ISOs. ISOs are organizations that go out to those individual retailers and say, we'll take care of your payment processing. And they deal with the first data, the payment processors. Well, these ISOs have the ability to shift the merchants onto LedgerPay over time. So basically, Quisitive can buy an ISO for 10 times operating cash flow, shift the merchants onto LedgerPay, and the multiple of 10 can work down to 7 or perhaps 6. So there is a long runway of accretive growth through acquisition ahead for Quisitive. So for us, we see value in the IT services. We see very aggressive optionality by virtue of the LedgerPay and the ISOs. Glad to take questions at the end, and then I'll just hand it over to Emmer. Emmer, over to you.
Thanks, Rob. I've nominated the same 2 topics at the last few quarters. Both are what I deem high-quality names. Both have earnings. Both are cheap. They're pretty resilient during the market shift we are seeing away from growth and into value. The first one is ReadyShreds, ticker is KUT. They've had a fantastic 2021, up 30% since our nomination into the topics portfolio. We think 2022 might be a better year. I think a lot of you have heard me speak to the story before. For those who don't know the stock, as the name implies, it's a shredding business, paper shredding. So it's the guys that come to the offices and shred all the papers we throw out. It is a high margin business, has recurring revenues, and they have both organic and inorganic growth in that they're executing an M&A strategy that I could speak to in a minute. The opportunity here is the stock trades 20 to 30% below its pre-COVID highs. So I'm looking at this and scratching my head in that it's 100% US exposed name, and a lot of the US is open for business despite the new variants. So ReadyShreds is busy and operating at near full capacity, so you'd expect the stock to have recovered to pre-COVID levels. We feel there's a total disconnect because it's micro cap. Not a lot of people are paying attention to the stock. The couple of incrementals that have happened since pre-COVID is the company completed a few tuck-ins, so the sales are higher, and the company is much leaner, so the costs are lower. Just to illustrate, pre-COVID, this company was $20 million in run rate sales. Today, we're at $40 million in run rate sales. And pre-COVID, they're $5 million in EBITDA. We're now at $14 million in run rate EBITDA. So not only is the stock down 20 or 30%, but the P&L is much, much stronger. In terms of multiples, it trades at 7 times EBITDA. The larger peers trade at 15 times EBITDA. When you look at ReadyShred, they're growing their top line at 15% CAGR, while peers are growing at 3 or 4%. The second stock is Calian again, ticker is CGY. This name is just quality, it's cheap. It's one of the larger small caps that I cover, 700 million market cap. Why we're so bullish, it's essentially two things. Number one, the stock's down 15% from its highs, despite reporting a couple of very solid quarters. In fact, they were record quarters. And part of that is a lot of the street feels these are one-off quarters that aren't repeatable. We don't think they're one-offs. We feel this is sustainable. So we buy here expecting very strong quarters to come. The second part is M&A. If you look at their acquisitions in 2021, we think they've increased their EBITDA per share by 20%. It's still not reflected in the P&L as all these acquisitions didn't flow into their income statement. And we feel investors are totally missing that. And it's simply being missed because this is a company that acquires very small targets. Like each target would add like 3 or 4% to sales and earnings, but they'll make like 5 acquisitions a year. So not substantial on a standalone basis, pretty hard to follow. But when you put it together and it flows through the P&L, all of a sudden you realize, holy mac, like they've added like 20% to their EBITDA. I won't walk you through what the company does. It's a pretty diverse company. You could think of it as a diverse holdco, which provides for great stability. In fact, the bulk of what they do is advanced tech, which are large satellite ground systems. They also have a health division where they provide staffing for national defense as well as a CRO business. Very high picture in terms of valuation. Like we've got 50% upside for a 700 million market cap company. It's not bad. Trades at 10 times EBITDA. Peers trade anywhere between 15 and for some peers like 20 times. Calian's growing in the teens where peers are growing at mid-single digits. Again, we'll do questions at the end. With that, I'll pass it on to Andrew Semple for Cannabis.
Perfect. Thank you very much, Amber. Just before we get into the cannabis names, just want to make a couple comments on the cannabis industry. 2021 was obviously a very challenging year for equity investors in the cannabis markets. The new Cannabis Ventures Global Stock Index was down 26% for the year. However, we are pleased to report on our substantial outperformance relative to that benchmark, where we returned positive 20.6% with our cannabis top picks for the year, a 46.6% outperformance. It certainly helps with High Tide's 245% return in Q1. However, we did also outperform in each of the 4 quarters of this year relative to that same benchmark and each of the 10 past quarters. In addition, in 3 out of 4 quarters of this year, we had identified the top performing cannabis stock relative to its like peers. So we continue to believe we're doing a good job, even in difficult market conditions, teasing out those winners and identifying companies that both have active catalysts and solid financial and growth opportunities ahead of them. With that, I'd like to get into the top picks. We are reinstating 3 of our top picks from last quarter. That is Air Wellness, Columbia Care, and Verano Holdings. Happy to start first with Verano. Verano is one of the larger companies we have under coverage. It is a very high quality business. It is one of the most recent of the large companies to list on the public markets, still relatively novel, having been listed for less than a year. This business, we believe, has been firing on all cylinders in 2021. It has had and we believe it also has excellent risk reward characteristics with one of the highest growth profiles in the industry, driven by its very aggressive but high quality focused M&A, as well as its under-levered balance sheet. If we look at the company's M&A track record year to date, since they listed in February to the end of 2021, Verano has deployed over or roughly 900 million into acquisitions in 2021. So it's been very, very active acquirer. And impressively, it was able to pick away at some of the top performing assets in some of the highest quality markets at an average valuation of 6.9 times our estimated 2022 EBITDA contribution from those assets. So, you know, it is very encouraging to see that M&A continues to be a tailwind for these businesses, and Verano certainly at the leading edge of that, with a focus on high quality assets and operations. In terms of the year ahead, and more specifically in Q1, we believe Verano is very well positioned to continue growth. In particular, we are excited by this company's position in the New Jersey cannabis market. New Jersey will be the next major market to implement legal adult use sales. We expect that the market size could swell from roughly 200 million in 2020 to more than 2 billion over the next 5 years, which would represent an increase in over tenfold in sales and the addressable market opportunity. Verano is one of the leaders in that market. They've got some of the most existing production capacity currently in the market. They have all of their dispensaries open and ready to go in that state, and they are very much looking forward to that adult use program beginning, where you should see a very material uplift in sales quite quickly after that is implemented. We believe adult use sales commence in the second quarter of this year, and we expect investors to begin positioning ahead of that in Q1. Reason that that should be a major catalyst for the Q1 for Verano in Q1. We also believe that it should report solid Q4 earnings. We are seeing a bit of a holiday bump across major markets. So we expect solid earnings, also supported by the contribution from recently acquired companies. And in addition, we expect Verano to be in a very strong position to continue to announce new M&A with significant cash on hand, 100 million of untapped debts that they can call down at their option, and the additional to seek additional debt if they see new M&A opportunities that they aren't funded for. In terms of the valuation, you're getting one of the biggest and best quality businesses in the US cannabis sector at 7.8 times our forward EBITDA estimate. This compares to the peer group average at 9.1, and the average for Verano's 3 closest peers, which we mark as GTI, Cresco Labs, and Cureleaf, at 11.2. So it is a substantial discount, a meaningful discount for what should be a higher quality operator that should deserve a premium to the peer group, actually trading at a meaningful discount. Our implied price target of $40 a share would imply upside of 150% at these levels. Moving on to Columbia Care, we also reinstated Columbia Care as a top pick. We saw this business make immense strides forward from a fundamental perspective in 2021. They closed one of the best acquisitions we've seen in the space, which is the acquisition of Greenleaf Medical. We believe that will pay dividends for years to come as they now get vertically integrated in the attractive Pennsylvania market, as well as move into the emerging Virginia market, now controlling 2 out of the 4 licenses issued in that state. So stranglehold on that market opportunity as that continues to develop. In addition, New York should be a substantial growth driver for this business in upcoming years. They're one of the first to market with increased production capacity, having chosen to buy capacity rather than build. So they have begun selling dried flower products in New York in Q4, and we believe the approval of dried flower will result in increases to the growth rate of that state in the upcoming year, as dried flower typically causes the medical market size to swell about twofold in the year after approval. So we are looking for demand to pick up in that state. So it's really this trio of high growth markets, the New Jersey market, which I mentioned with Verano, the New York and Virginia markets, which are unique to Columbia Care in particular. It's these trio of high growth, massive market opportunities that makes Columbia Care very well positioned to continue to drive growth ahead in the new year. In terms of the catalysts we are expecting for Q1, again, New Jersey is a key reason and a key driver for growth in the year ahead, and we expect it to be a catalyst as investors begin positioning companies with exposure to New Jersey ahead of sales beginning in Q2. The recent dried flower approval in both Virginia and New York should drive outperformance and strong growth out of those medical markets in the upcoming year. And finally, Columbia Care next year will be deploying almost 800,000 square feet of new production space, which will really help this business catch up to peers in terms of EBITDA margins and gross margins as they begin to get vertically integrated in each state where they operate and adding depth to those markets. So we believe that will be a catalyst throughout this year, and you'll start to see some of the benefit of that in the first quarter. In terms of valuation, Columbia Care trades at 7.6 times our EV to 2022 EBITDA estimate. So that is again discounted to the peer group average, excluding Columbia Care, at 9.3 times. And our price target would imply close to 290% upside from current levels. So almost a four-bagger. And then just our final top pick would be Ayr Wellness. Ayr is currently one of the longest serving top picks that we've had. We initially made a top pick in Q3 of 2020. Since then, it's added about 91% of contribution to the top picks portfolio. Its recent underperformance in Q4 was a surprise for us. The business continues to be on very solid footing from a balance sheet perspective. The markets that they are in continue to look very attractive. They have been successful in closing all of their major M&A. Still some bits and pieces coming in, but the largest transactions are closed and are now going to be consolidated in upcoming quarters. So you will begin to see the tailwinds of the acquisitive growth as well as the organic growth from those markets begin to contribute very meaningfully in 2022. We believe several of the pending acquisitions that are still to close will be further accretive to the company, including acquisitions in Illinois, Nevada, and it's adding a beverage brand as well, the second best beverage brand in the US. So we expect second highest grossing beverage brand in the US. So we expect that to be accretive to the overall portfolio. And we expect those closings to be a catalyst in the first quarter as the company's financial outlook for the year becomes solidified as those deals begin to close. In addition, this is another business in the New Jersey market. You can see there's definitely a theme here. We're making a point of adding 3 companies with exposure to New Jersey. Ayr closed its acquisition of a New Jersey operator in the third quarter. You'll see the first full quarter of contribution in their Q4 results, and they will be ready for the adult use market when that happens, as we believe it will in the second quarter of this year. And then a final catalyst, we believe that this business has experienced very strong demand for its products, and it has actually run into supply chain issues with being able to keep up with that demand. So we do believe that facility announcements, particularly in the states of Florida, Massachusetts, and Pennsylvania, where they are supply constrained, will further help sentiment on this stock. And we expect to see further progress on facility openings and progress on organic growth in the first quarter. At 5.9 times our 2022 EBITDA estimate, Ayr's valuation multiple, we believe, is the most compelling in the sector. It is one of the most discounted of the high quality, fully funded names we have in our tracking group. and it is a substantial discount to the 9.5 times average multiple of US cannabis peers, excluding AIR. If you look at our target price of $75 per share, that would imply upside of close to, again, a four-bagger on this stock over the next 12 months. Just a final point, there are pretty high implied upsides across all three of our coverage names. We just want to make a point and note that our target prices do not rely on federal cannabis reform in the US to achieve those. If federal cannabis reform happens in the US, you could see potentially valuations even much higher than that. So this is all on what's been announced and what's been achieved to date. So just want to make that final point. And then with that, I believe I will be turning it over to Stefan. Stefan, over to you.
Thank you, Andrew, and Happy New Year, everyone. It's good to see you all. So I'm sticking with our same two names from last quarter, Quipt Home Medical and Diagnose. The reason is we think both names have attractive valuations and upside from potential catalysts in the next few months. I'll start with Quipt. It's got a 11.25 target and about 60% upside from current levels. For those of you who don't know the company, they're a US-based distributor of durable medical equipment for at-home care of patients with respiratory problems. So think of things like ventilators for people with breathing issues and CPAP instruments for people with sleep apnea. We like the business because of three major drivers. The first is strong demographic tailwinds from an aging population that drives organic growth in the mid to high single digits. The second is what I like to say is the company's in an M&A sweet spot due to its industry structure. Very briefly, the industry is dominated by a few large national players, just a handful of them, which are about 5 to 20 times larger than Quipt. Then there's another tier of regional or scaled regional players like Quipt. Quipt is one of them. There's about 10 of them. And then about 6,000 small mom and pop players that have sales of less than $10 million. And the M&A sweet spot comes from, a company the size of Quipt is able to, at very attractive and accretive multiples, buy the smaller players in the range of sort of 4 to 5 times EBITDA pre-synergies. And at the same time, Quipt is a potential M&A target of one of the larger national players. And the third thing we like is that there's an obvious ongoing shift to at-home care. Rob obviously talked about that with his names. This was certainly accelerated by COVID, but it's certainly going to last beyond the pandemic. Because patients prefer it, but more important than what patients want is that payers prefer it as well, because it provides meaningful cost savings to them and the healthcare system, because it's much cheaper to care for someone in the home than it is in a hospital or at a nursing care center. So in terms of catalyst for the company, it's just ongoing operating performance, which has been very strong for the company, despite the challenges of COVID has caused on the sector, as well as ongoing accretive M&A that could lead us to increase our estimates. We're very confident in the company's growth trajectory. We have been growing over 40% in fiscal 2022. We're confident in that because the company announced a spate of M&A transactions late last year, which are in many of which have already closed, but one is still left to close. And it basically assures this level of growth is largely baked into the numbers. So we feel quite good about that. At the same time, as the company's scaling its top line, there's potential for it to also expand its EBITDA margin from the low 20s, where it is currently, to about, say, 25% as it gets up to a $200 million runway, which is probably going to happen in the next year and a half timeframe. And finally, on valuation, the company is very attractively valued. It trades at about 7 times this year's EV to EBITDA, compared to peers at 11 times. So, to summarize, we think it's a very attractive name. It's got the trifecta of stock returns. It's got top line growth, potential for margin expansion, and potential for multiple expansion. Moving on to Diagnose. Diagnose is a much smaller technology company that's moving to its commercialization phase. Basically, Diagnose has an artificial intelligence platform to diagnose diabetic retinopathy. I'm not going to go into too many of the details, but diabetic retinopathy is a leading cause of blindness in adults. It occurs when unhealthy blood sugar levels in diabetics cause blood vessels to grow on the retina in the back of the eye, and that leads to vision loss. The process is asymptomatic. The diabetics don't feel this happening. And the only way to identify the problem before it causes irreversible blindness is to take a picture of the retina, the back of the eye, using a special camera that are used by eye doctors, and by grading the severity and getting those with the most severe cases treated. There are treatments, but you have to identify the right people to do it. So Diagnosis developed an AI system that does this extremely well and efficiently. And their business model is a highly scalable software as a service, or you could say AI as a service approach, where they charge $5 to $10 per diagnosis. So this is a win-win for eye clinics and optical retailers that charge about $30 to $50 for this type of test, since it allows them to see more patients and allows doctors to be more efficient and focus on more valuable procedures. Just to give you a sense of the opportunity, there are about 450 million diabetics in the world, and they're all supposed to have a retinal exam once a year. So this is obviously a multi-billion-dollar market opportunity. So the company's technology has been deployed and piloted with a number of partners around the world, but a lot of that got sort of waylaid and delayed by COVID over the last year and a bit. And the hope there is that's going to start up again as we slowly move through the delays to like non-COVID healthcare, which has been plaguing the industry large, in a larger perspective. So it hasn't just been eye diagnoses that have been delayed, but even cancer diagnoses and cancer treatments and knee replacements. So they have been suffering from that, but we think the worst of that is hopefully behind us. Nevertheless, the company's been very active on the business development front and has been working on winning a number of meaningful contracts, and we expect more to come in the coming quarters. Last year was a very important year for the company. They signed their biggest deal, which was with Canada's largest optical retailer called New Look. They have about 400 stores, and as we speak, they're installing their software in their network. I spoke with the company recently. They're installed in about 15, 20 stores, and the hopes is that throughout this year, they're going to get it installed across most of the network, and it's going to really lead them to grow their top line and demonstrate the validity of their business model in the coming quarters. But more important than that, and probably by far the biggest opportunity for the company, is that last year also, sort of in August, they announced that they signed a memorandum of understanding with EssilorLuxottica, which is by far the biggest player in the space. They have over 15,000 eye care locations around the world, so 40 times bigger than New Look. And the hope and the major potential catalyst for the company is that they sign a contract with EssilorLuxottica in the coming months, which would be an absolute game changer for the company, and would be obviously a boon for shareholders as well. So with that, on valuation, we have a $1.55 target, which is a mix of a DCF and comparables with health IT companies. So there's a lot of upside, particularly if they can sign that EssilorLuxottica deal. With that, I'm done. I'll hand it off to David Crystal, who will tell you about his picks in the real estate sector.
Thanks, Stefan. So after a good performance in 2021 from the broader REIT sector, we think that in the year ahead, investors should be a little bit pickier. We continue to favor names in the space with strong underlying fundamentals, good cash flow and NAV growth prospects, and reasonable valuations. So with that as a backdrop, I'll introduce you to our first top pick, which is BSR REIT. We're returning it to the list after a strong Q4 and strong full year 2021 performance. By way of background, the company owns a portfolio of high quality, newer generation garden style apartments concentrated in 3 markets in Texas: Dallas, Austin, and Houston. The story in Texas is that it continues to attract major business investment and interstate migration, particularly from California, where regulations are much more stringent and real estate prices are significantly higher than the alternative in Texas. Over the past decade, Texas's population has grown at 2 times the national average rate. By all demographic projections, this is expected to continue for the next decade, 2 decades, 3 decades, whatever the projection is. This is driving outsized demand for apartment accommodations to house all these new immigrants, these interstate immigrants, in a U.S. housing market that nationally is exceptionally tight and is rebounding, particularly in the apartment space, is rebounding with a vengeance after a year of pent-up demand in 2020. Market rents in BSR's core markets increased by 17% through the end of 2021. Importantly, there's no rent control in Texas. And in fact, in a market where regulation is becoming a bit of a concern north of the border, we think the likelihood of rent control ever making an appearance in the state is essentially negligible. Texas will be the last place to table rent control legislation in our view. What this does is it allows management to increase expiring rents to market immediately, unlike most of the Canadian counterparts, which are limited to a guideline increase of typically between 0 and 2%, until a tenant actually leaves the apartment by their own volition. Despite what was an exceptionally strong 3rd quarter financial performance, where they delivered 13% organic net operating income growth, we think they've still got a very strong runway ahead of them. In terms of market rents, we have not seen the typical seasonal weakness in their markets that we would see in November and December. Generally, you would see rents decline in the winter until they pick up again in the early spring. We saw November flat and December actually positive, which is a very good result. Further, much of the rent growth that we talked about in 2021, that 17% figure, a lot of that growth occurred in the 3rd quarter of 2021. What this means is that Q4 21 results are lapping a very weak quarter in Q4 2020. Q1 results are also lapping a very weak quarter, and Q2 results are lapping a quarter where we're just starting to see the early signs of growth in 2021. So they've got a runway of 3 very strong quarters of organic growth coming up, which should drive per share cash flow and NAV. Finally, they continue to trade at a discount to their to their closest US peers. They trade at 23 times forward earnings versus the peer group at 27 to 29 times. Their 65% total return in 2021 actually lagged their closest peer group, who delivered between 80% and 100% total return in the year. And importantly, this is despite BSR delivering an operational performance that was ahead of the 3 peers that make up that group. So we still think there's a lot of room to run in this name. In the real estate space, it ticks the strong fundamentals, the organic growth, and the attractive relative valuation. So we are returning it to our top pick portfolio for the quarter. And I'll go to our next name now. Killam Apartment REIT, again, another returning name. This is a pick in the Canadian space that again ticks the three boxes that we mentioned: the strong organic growth, the strong underlying fundamentals, and an attractive relative valuation. 2/3 of Killam's portfolio is concentrated in the East Coast. Historically, the East Coast has lagged both economically in apartment demand and population growth. But over the last few years, what we have seen is a very pronounced shift eastward. It began with the cratering of the oil market in 14-15, which sent a lot of employees and individuals working in the oil patch who had originally migrated for economic opportunities from the East Coast. It sent them packing home. What's happened more recently is exceptionally high housing prices in Ontario have driven Ontarians eastward, particularly in the last couple of years where COVID has made working from home a possibility while retaining central Canadian jobs. So we've seen a huge influx of interprovincial migrants back to the East Coast. That's something that we have not seen since the 70s. That's driven outsized population growth, outsized apartment demand, and outsized tightness and market rent growth in the East Coast markets. Further and very additive to this is a federal government that is championing international migration. We saw a significant lull as a result of border closures, as a result of foreign students going back home when in-person learning was paused. What we saw in the third quarter was, frankly, the strongest quarter of international migration that we have seen historically, and we expect that to continue. Now, the East Coast received their pro rata share of international migrants. It's not a large headline number when compared to Ontario, when compared to BC, but when you're putting an additional 10,000 people in one quarter into a market that is, in terms of population, significantly smaller than the larger provinces and already has very tight rental fundamentals, you're obviously exacerbating a problem of finding affordable housing, and you're driving rents further upwards. We mentioned the regulatory environment. There are some regulatory challenges in the East Coast. In Nova Scotia, where Killam's got about 30% exposure, there is a temporary rent cap at 2%. In the context of Ontario at 1.2%, it's actually a favorable number. Importantly, though, one of the few remaining provinces without rent control is New Brunswick, where roughly 20% of the REIT's portfolio is located. And they're seeing, in some cases, low double-digit rent growth on turnover, which in the Canadian landscape is exceptionally strong. So obviously the fundamental backdrop is exceptionally attractive in the context of the Canadian REITs. Killam also enhances their organic growth profile with a unique development pipeline. They're expected to deliver about 500 suites over the course of 2022. The first quarter will be a couple developments expected to add 25 to 30 cents per unit of NAV. And their all-in pipeline now sits at about $1.2, $1.3 billion. Over a decade, this should translate into $2 of additional NAV per unit at the low end. And that pipeline refreshes itself as they acquire land or build out pre-development plans for some of their excess land. Finally, part of the appeal here is that it does trade at a discount to some of the Ontario-centric peers. You can see it trades at 26 times our forward EBITDA versus the Canadian peer group, a couple turns higher at 28 times. The Ontario-centric peers have historically traded at a premium owing to stronger fundamentals, deeper demand for that product, and stronger underlying economics and population drivers. In our view, not only should the valuation gap narrow, but we see stronger organic growth out of Killam REIT than the Ontario peers, given the strength of the East Coast. And that should contribute to narrowing this valuation discount over time. So again, we're bringing Killam back to our top pick list after a strong fourth quarter and strong full 2021, because again, it ticks off those three boxes we look for in the REIT space. And with that, I'll turn it over to Ryan and Gabriel in Metals and Mining.
Okay, thanks, David. Appreciate it, and happy New Year, everyone. So, sticking with the theme, kind of two returning names that have at least one been on the top pick list for a while. First, common theme between the two. I think, with some success, either of these, if not both, could not be around by the end of the year, given the catalysts they have coming up. So we'll start with Osino Resources first. And so you probably remember this name. These guys are developing the Twin Hills Gold Project in Namibia. Why we like it, solid management. These guys have been through the process before. They sold the nearby Otjikoto mine to major producer B2 Gold back in 2011. So it's the same team, moved down the highway 100 kilometers, and it's very much rinse and repeat. Solid asset, 2 million ounce resource, about a gram, nothing sexy, but just solid. The company put out a PEA toward the end of last year, and solid economics. IRR 38%, off the shelf processing, boring, but it's a mine in waiting. A lot of stories out there with bigger market caps will never see the light of day, but this is just kind of methodically moving along. So catalyst for the quarter. The main ones, they finished off 35 deep holes toward the end of last year, and this is to test underneath the existing resource, see if there's legs at depth. And the company reported that the core came out and they were visually positive. So a good sign there, but we have to wait for the assays. So that'll kind of when they come out, provided they're good, kind of provide some foreshadowing of resource growth. Still lots of exploration potential. Going forward, they've got about a 7,000 square kilometer land package and really have been focused around the Twin Hills Central deposit, and have done a little bit on the rest of the package, but lots of room to grow here. And we could see within the quarter some exploration drill results as well, but timing on those is kind of ephemeral right now with the situation across the sector with assay labs. So we got the drill holes. Then in Q2, we get an updated resource estimate, again with that deep drilling and some other more regional drilling, and that will feed into a pre-feasibility study, and that's looking to change the scope of the project a little bit from the PEA. They'll increase the planned throughput rate to 4.5 million tons per year from 3.5 million tons per year, and that's aimed at really kind of bringing some of the value forward, bring the ounces forward, get the production up to 150,000 ounces per year or thereabouts, up from the PEA that was at about 100,000 ounces a year. It just broadened kind of the appeal of the project to a broader audience. At 150,000 ounces a year, there's not a lot of development projects in that size bracket. In a solid jurisdiction, Namibia, you don't really hear any bad headline news about Namibia. No terrorist attack, that kind of thing. They've got a 100+ year mining heritage there. Pretty quick permitting regime compared to North America and other jurisdictions. And where they're situated, you're not bringing in power from hundreds of kilometers away. It's flat land. You basically put your roads where you need, plunk your infrastructure down. Simple open pit, simple permitting, and you're off. Simple processing, and you're off to the races. So, like I said, some drilling, pre-feasibility study, and then all that leads into a bankable feasibility study in Q3, a little bit more drilling just to firm things up. And then that opens up the window to financing, and also those studies with fresh economics in them opens up the window for M&A as well. So either way, either they get taken out or Paya Don, the CEO here, is a mining engineer, been around forever. I think the company has the wherewithal to put this into production themselves. So either way should be a winner. So that's really it on Osino in a nutshell. And then what I would call our top pick, Pan Global Resources. So these guys are an exploration company in the Iberian Pyrite Belt in Spain. This is where you want to be for VMS deposits. That's where the type deposits are, where the giants are. And these guys are sandwiched right in and amongst those giant deposits, you know, hundreds of millions of tons surrounding them. And they've been focused on the Escacina project, and more specifically there, the La Romana target, which is a big geophysical anomaly, a gravity high. So a big slug of metal in volcanic rocks just glows when you do a gravity survey. And that's invariably how these deposits are found in the Iberian Pyrite Belt and elsewhere. So went in there, drilled that. They're up to hole 113 now. I think they've reported results for 90 of them, and they haven't missed yet. So drill to find over more than a kilometer of strike, down dip to about 300 meters depth, and still searching for the edges of this thing, and just consistent mineralization from surface, running at about 1% copper equivalent. It's mostly copper and tin. Tin is nice to have, as that price is at all-time highs right now. So just still searching for the edges. Based on what they've drilled so far, you can kind of back of the envelope see 30 million tons, and really still another kilometer or so of strike length to test based on the geophysics. So, you know, potentially a double there. But the big catalyst, and Rob mentioned it, you know, put in a 33% increase during Q4, and that was largely ascribed to getting the permit for the neighboring project immediately to the east, the Al Andalus project. It's really one big project, but they've got 5 of these gravity targets, lookalikes to La Romana, sitting right there, waiting to be drilled. They've kind of set fallow for a few years because they were under Boliden back in the 90s, and of course they had a big tailing spill at Los Frailes just up the road, and we're kind of left the country with their tail between their legs, and nothing happened until Pan Global picked it up here. So they've got that permit now in hand. They'll refine some of the geophysics, go in and test those anomalies, but they're really not kind of grassroots anomalies. One of those targets was tested in the mid 80s by Exxon Minerals and returned 9.5 meters at 1.4% copper. So, you know, proof of concept right there. So initial drilling will go there, obviously follow up on that hole, and then start targeting the rest of these targets, anomalies. And really, you know, $150–160 million market cap based on one target, based on, you know, how many of these targets yield success. It's pretty easy math to multiply by 3, 4, or 5 and get to your new target. So should be an exciting year for the story. They'll continue kind of trying to find the edges of La Romana and get aggressive in drilling on the Al Andalus side. They want to get up to, you know, 6 drill rigs going. They've got $17 million, so well funded. Get in there, get aggressive, and really, if some of these other targets start to yield similar results to La Romana, you really could see these guys getting taken out this year. I mean, multiple operating mines in the neighborhood, I'm sure, are keenly aware of what's going on there, and we'll just see how things go, but it should be an exciting year, and that is Pan Global. So I will now pass the torch on to Gabriel for his topic.
Thank you very much, Ryan. So my topic for the quarter is SilverX Mining. That's ticker AGX on the TSX Venture. I have a speculative buy rating and a $1 per share price target. SilverX is a relatively new publicly traded company since the go public merger between OroX and Latitude Silver. That happened in June of last year. The asset itself has been in production since about 2019, though, and because it really just went public recently, I think it's still very much flying under the radar. It's not on a lot of people's screens. And I think that's going to change once the company delivers on the expanded production. They're expanding production from 600 tons per day to 720 tons per day, which is good for about 2 million ounces of silver equivalent of production per year. Now, the story is very undervalued. It trades at a P/NAV of about 0.2 times versus the silver producer average of about 0.8 times, and at an EV to EBITDA of about 3.3 versus an average of 5.3, and price to cash flow of 3.9 versus 6.7. Now, you wouldn't necessarily expect a company that's producing 2 million ounces of silver equivalent per year to trade up to the average, but it is nonetheless very inexpensive from where I'm sitting and where I'm seeing things. Interestingly enough, on an enterprise value to ounce in the ground basis, which is really a metric that you use for developers and explorers, not producers, SilverX trades at 36 cents per ounce of silver equivalent ounce in resource. And that's versus the silver developer average of 91 cents per ounce. So this thing is in production, but it trades like exploration and development company, not as a producer company. So really on any metric that you look at it, it's trading very cheap. I would point out that I think one of the better comps out there for the company is a company called Guanajuato Silver, which is also producing about 2 million ounces of silver equivalent. They're roughly about in the same stage of company ramp up. But Guanajuato Silver has about a $100 million market cap versus SilverX's 40 million. Guanajuato Silver is obviously, given the name in Peru, in Mexico, and SilverX is located in Peru, which, despite all of the political talk, is still nonetheless a very good mining destination. In terms of catalysts and re-rating, as I mentioned, I think the delivery of free cash flow and expanded production will start getting this onto people's radar screens, and you should get a re-rating on the stock. There is potential overhang on the stock from a US $4 million debenture, which is convertible at about 55 cents per share. That is due on June 30th of this year. So either the shares get traction as the company starts delivering on this expanded production and positive cash flow, and the convertible debenture gets converted, or basically we wait until the June 30th maturity of the debenture, at which point that overhang will have lifted. There are plans for further production expansion. So the company has commenced permitting for an expansion to 2,500 tons per day. That would take annual production from about 2 million ounces of silver equivalent per year to well over 6 million ounces of silver equivalent per year. And that would place it solidly in the junior silver market segment. Really, at that point, you're looking at what Fortuna Silver did when it first came out, and with the Cayoma mine back in the late 2000s, and that was really a springboard for it to become the company that it eventually became. So this is very much a company builder type mine, and I think this could really be looked at as Fortuna Silver 2.0, the type of situation. I should mention that mine development has been a little bit slower than expected, and they've run into some downtime with a ball mill at the plant. So whereas commissioning of the expanded 720 tons per day was expected in December 30th, it's now expected in mid-March. So it is, a fairly significant delay. I'm not overly concerned about it, only because they are still nonetheless producing at anywhere between about 550 to 600 tons per day. But that's is going to have to be a situation that we look at closely. But I think the risk-reward proposition here, considering how cheaply it's trading, is worth taking a look at. So upcoming catalysts, you have the commissioning of the plant expansion to 720 tons per day. Again, that should be about a mid-March timeline. Updated resource estimate in Q2 of 22. Right now, the 7.3 million ton resources all inferred. And so the updated resource estimate will provide measured and indicated level confidence in the resource, as well as significant resource expansion. That 7.3 million ton resource that I mentioned, that was just off the back of 3,000 meters that were drilled to 2019. And right now they have a 25,000 meter drill program, again, to upgrade, infill and upgrade resources, as well as expand resources. And then in Q3 of this quarter, you will also have, Q3 of this year, you also have a PEA on the project, and that should provide as well, de-risking to the story for somewhat more risk-averse investors. So that's really the rundown on Silver X, and with that, I will turn it over to Michael Mueller.
Thanks, Gabriel. Introduce my top pick for the quarter. It's E3 Metals. I recently launched coverage on the name. This is a junior lithium brine developer in Alberta. They're developing their own extraction technology in-house. And they're really the only company that's looking at using DLE, that's direct lithium extraction, that also owns 100% of the resource as well as the technology. So this really gives them a very high ceiling without needing to acquire more land or resource. I do like this name near term in this quarter. It's underperformed the group, the run in the lithium space the end of last year. On an EV to resource basis, they are significantly undervalued at about $20 a ton, whereas the group averages tenfold this. In my view, one of the biggest reasons of this discount has been just from the technology risk overhang. But they are conducting tests currently. Just this morning announced another positive test results here. So all of this should continue to de-risk that aspect of the story. Would also say the closest comp to E3 is Standard Lithium. They are also developing a DLE technology. They have already constructed a larger scale on-site prototype, whereas E3 is effectively still at the bench scale, moving to a field-based prototype later this year. As I look at it, I consider Standard to be 12, 18 months ahead of E3 on the development curve. And just for context, Standard trades at about 20 times E3 on an EV to resource basis. So what this does is really highlights the runway E3 has the potential to move on. Another key point unique to E3 is its operating jurisdiction in Alberta. E3 has applied for some grant support that would go towards its field-based pilot this year. They are eligible for 42% of the capital spent on the facility. Receipt of these applications could be expected this quarter. They have very strong support in both the provincial and federal levels. As well, because of the nature of the lithium brine production, they are able to leverage the expertise in oil and gas development here in Alberta. As well, there was a bill recently introduced to the Alberta legislature. That bill seeks to give the oil and gas regulatory body oversight over lithium. So if this gets passed, that would effectively mean that E3's permit for commercial production would be one of the quickest turnarounds out of any lithium project, as its permit to produce would in effect be the well licenses and a facility license, which typically have about a 6 to 8 week turnaround in the oil and gas space. We do have a $5 price target and speculative buy rating on the name. This price target is based on a 0.7 times risk NAV model using 15,000 US lit per ton lithium prices. Again, lithium prices have been on a run. We're about 50% higher than the last cycle in late 2017. Recent spot prices have been north of 45,000 US a ton. Again, our estimates and our models around E3 have a lot of leverage to changes in these commodity price assumptions at about 3 times. So just for context, a 10% increase in our assumed lithium price would add about $1.50 to our price target. So this is a name with a lot of catalysts coming up this year, just through proving out its DLE prototype technology. They've got 2 to 3 wells they'll be drilling in virgin regions of the resource space in Alberta this summer, where they are expecting higher lithium grades, just given the lack of historical oil and gas development in the region. So lots of news on the come for this name here. So I'll pass it, I guess, back off to Rob or Amber here to wrap up.
Thank you, Mike. And so we encourage anyone where you have questions, please jump in. I perhaps will just jump in with the first one. And Mike, since you were there and speaking, can you talk to the DLE technology in terms of how do we get a measure of comfort? What mileposts or data points are you looking at, and what is the timeline there, so we can sort of monitor that one more carefully?
Yeah, it's a fair question. Really, I mean, this is paramount to this story and this project. Is this technology working? Just given it's still in the lab at prototype stage, I looked at all the test results that have come out. There was initial results late December, and then again, as I mentioned this morning. And I looked at those test results being within the vicinity of what their initial bench scale prototype resulted in. So far, so good on that end. Again, continued, they're working on really isolating the parameters before they go in the field and scaling this up. So the initial results have all been promising, where they're seeing recoveries of up to 97%, which is what they've communicated and what they've modeled internally. So I continue to look to those. I think that gives some more comfort on that end of things. And they do have a second train running through their prototype here with results on that expected this quarter as well.
Okay, thank you, Michael.
Maybe if I could jump in, Rob. Maybe you could speak to Converge and how sustainable the inorganic growth profile is. I mean, with yesterday's acquisition, that's 26 acquisitions in total. Then maybe you could touch on the valuation of targets. Are these acquisitions getting like much more expensive as they're getting larger?
The key, thank you. You know, the key thing with Converge is that the US and European IT services market is really fragmented. So Converge is going after those companies that are targeting the small and medium end client. And in the case of Converge, with each of those acquisitions, they have been non-competitive. And it's a case where Sean, a good portion of his job function is networking. So he's always developing that pipeline. And I think probably the best response that I can give to you on this is just watch. This quarter, I think you're going to see another acquisition in Germany, to be specific. I think you're going to see another acquisition in the US. There are no signs of the availability drying up, valuations getting higher, and you know, the same tricks that they have in terms of extending payables from 40 days to 90 days, it's there. In terms of moving the acquired company onto the platform where they buy almost exclusively from Ingram, that still works. And you know, behind their formula, Converge is arguably the largest buyer through Ingram, Ingram being one of the top 2 vendors across North America and into Europe. So Ingram knows that where Converge buys a company, Converge is going to buy from Ingram. So Ingram is out there sourcing these targets and feeding them into Sean and Converge. So I think the cadence is very sustainable.
Great. So then maybe another one for both Rob and Stefan. Rob, maybe you could speak to Quisitive and the risk of timelines being deferred by supply chain constraints. Then maybe Stefan, you could sort of speak to supply chain and the impacts or potential impact on Quipt?
Sure. Quisitive, in its normal course of business, doesn't have that much exposure to supply chain. Actually, Converge does, in that Quisitive is less of a hardware seller, but unique to this moment in time, Quisitive is looking to get Visa and MasterCard to give the final check on commercial validation of their ledger payment platform. And as we sit, there's one boat out there with $40,000 worth of equipment that Quisitive needs to get into the hands of Visa and MasterCard for them to use for that final test. Frankly, I don't know if that boat has landed, whether it lands next Monday or the following Monday, but in an odd way, Quisitive has been hurt by supply constraints. But I do see that opening with the landing of one boat. Stefan?
Yeah, sure. Yeah, thanks, Rob. And it's a good question, Amber. So for Quipt, it's obviously the supply. They're a distributor of medical equipment, and there's already, totally unrelated to Omicron and supply chain issues, there's been a issue of a recall of Philips, which is a big producer of CPAP systems, which are used for people with sleep apnea. They had a recall which has affected supply chains in the industry last year, and it's still impacting the industry. And then there's the broader ones that are ongoing. What I can say is so far, Quipt has done a fantastic job in terms of dealing with the Philips recall. They actually are a supplier of another manufacturer, so they've actually been doing relatively better than other players. But it's certainly going to impact their operations to some degree, because they are in a lot of ways the supply chain, getting things from manufacturers to the end customers, and it is impacting them. But from what I understand and talking to them, they're managing through it relatively well. But the thing I would say on the positive side, a lot of the smaller players, which are their acquisition targets, are having a much more challenging time navigating this, which is giving them a lot of opportunities for tuck-in M&A and making it for maybe opportunistic opportunities in terms of finding a smaller M&A target. So, certainly it's a challenge. It may impact their margins this year, but obviously not longer term as they continue to scale. And it's providing opportunities for smaller, less savvy players. Those disruptions are giving them M&A opportunities. A very long answer, but that's it.
Cool. And perhaps, Amber, if we can turn it back to you. Can you discuss what Omicron has done to Calian? And on Calian, notably, they did not buy into telehealth, looking at the valuations being stretched. Might they now be entering that field, or what do you see them doing on M&A?
Thanks, Rob. A couple of thoughts there. First, on the new variant, is actually a net positive, we think, for Calian. We saw that last year. They've helped a lot of levels of the government with screening and vaccination efforts. It has a good amount of revenues and EBITDA. Hard to quantify because they don't actually provide that level of detail. But my guesstimate is it could add like a good 4 or 5% to total revenues and EBITDA, which is quite large. In terms of M&A, yes, they did not do anything on telehealth. This is a company that is extremely disciplined when it comes to M&A. In fact, and you could go check out their website, they do tell potential targets, please do not contact us if you can't express a takeout multiple using LTM EBITDA, i.e. if you're not historically profitable, we're not really interested in buying you. I think valuation would still be problematic for them, despite all of these telehealth names looking much more attractive. But in terms of like M&A, like the company's got $80 million in cash, 0 debt. They could probably add $100 million in debt and still be under leveraged. So theoretically, $200 million in dry powder, and that could add a good like 50% to their EBITDA without dilution. And that's where we think, like there's a big opportunity.
Cool. Thank you. Maybe we'll turn to mining for a moment and maybe go with Gabriel. Silverex looks really, really attractive, really undervalued, but the devs are an overhang. What happens if they don't ramp up as expected? They can't convert the devs. What options do they have?
Sure. Well, the first thing to point out is that the holder of the convertible debt is actually also a shareholder, and they have previously converted a smaller issue that they had with the company to equity. So I think generally speaking, the holder of that debt is aligned with the company and would potentially look at the possibility of restructuring that convertible with a portion payback in shares, and perhaps refinancing another portion down the road. I think ultimately what it'll come down to is whether or not that production ramp up gets delivered on schedule. If it's a little bit delayed, as we're seeing, I think that the company still has enough cash on its books and will be able to continue producing at the run rate that it's producing right now to generally give it enough wiggle room to find a solution to the convertible debenture if it is not converted beforehand. So with that as well, I mean, there's possibility that they could change some of their expenditure plans for exploration, things like that. So again, enough wiggle room that I think they'll be able to make do with the situation, and have that overhang dealt with at the very least with repayment by the end of the June 30th maturity term.
Okay, I'll jump in with a few quick ones. We just recognizing time. We'll stick to mining. Ryan, just in general, like we're seeing like a lot of capex increases across the mining sector. Do you see this impacting your companies in 30 seconds or less?
Yes. End of answer. Yes, in the case of Osino, look, I mean, the capex they're looking at is pretty modest. It's in the neighborhood of about $200 million. That's PEA level, so you take that with a grain of salt. But given that they're in Namibia, it's a modest sized project. Yeah, there would capex creep, but there are ways to offset it. And in Namibia, just by example, your mill in Namibia, you don't need to enclose the mill in a building. So you save a couple $1 million there. There are opportunities like that. The issue will be the capex will go higher in the PFS just based on the scope change. Again, remember I was mentioning they're going to increase the throughput to about 4.5 million tons a year from 3.5. So that's going to boost your capex right there, and there will be some cost inflation. It's unavoidable, but that'll be offset by bringing a lot of value forward. You're bringing all those ounces that were later in the mine life forward, so you derive value that way. So not too concerned. And then there's options to maybe change things around. Some scale and scalability is kind of one of the things we look for. They brought on this Ondundu project last week from V2. That's another 500,000-600,000 ounces, about 100 kilometers away. Higher grade stuff, 1.5, 1.6 grams. Maybe you ship that stuff. You concentrate it up there, truck it down, and run that through the mill earlier on rather than later, and improve your economics that way as well. So, not looking for a massive capex blowout. The PEA is pretty fresh. It was back in August, so yes, there's been inflation since then, but the numbers are pretty fresh. And we're not talking about billions of dollars capex. So some of these big porphyry type projects, that's where you get into the when you start off at $2, $3, $4 billion capex, quickly balloons to $8.9 billion, which we saw last cycle. It happens.
Mm-hmm. Mm-hmm. Cannabis, again, 30 seconds or less. Andrew, do a lot of the companies in your space need to raise equity to help finance their growth? And if that's the case, how should we think about that with stocks down substantially?
Yeah, great question, Amber. I think when you look at our coverage names, we tend to focus on companies that are fully funded with their business models. So they have the flexibility to be more picky on when they choose to raise equity capital. You'll note most of my coverage names have not raised equity capital since January or February of 2021, back when share prices were substantially higher than they are today. A second point of that is we're seeing a massive increase in the availability of debt capital and collapsing costs of debt capitals for many of my coverage names. I estimate that the cost of debt has fallen by 200 to 300 basis points or 2 to 3 percentage points within 2021 alone, and over 500 basis points since the beginning of 2020. We're also seeing not only the cost of debt fall, but the availability increase. And you're seeing that in some of the largest ever debt deals announced. Curaleaf just raised $475 million in a single private placement issuance with investors. And they are, you're seeing many companies being able to use debt capital to fund the next leg of growth, including M&A. So really it's a two-piece, the flexibility on choosing when to raise equity and the increasing availability and lower cost of debt that we think that all of our businesses are fully funded with still optionality if they want to grow faster through M&A.
Maybe we could cap it off with David on REITs. Can you speak to the impact of inflation and rising rates on cash flows and valuations in your sector and how your top picks are insulated?
Yeah, absolutely. I think, it kind of rings through why my philosophy is targeting companies that can grow. Ultimately, we think that anyone with a long-term debt profile is insulated on the cash flow side of things, and anyone with a short-term lease maturity profile and pricing power is insulated on the cash flow and NAV side of the business. So in the apartment space, you've got lease terms that are typically 1 year and then roll over to market rate if a tenant departs. But more importantly, and we highlighted this with BSR, without rent control, you can mark to market on expiry, whether a tenant stays in place or not. And in my view, the best defense against inflation is 17% organic top line growth. And there's no way OPEX is inflating as quickly as the top line is. So what you end up seeing is the bottom line can actually grow, margins can expand, and you end up getting NAV growth that way. So I think you've got to be very selective in real estate, but there are asset classes that will do very well even in an inflationary environment.
Very good. Thank you, David.
Okay. Hey, Rob, I was just going to do, I think it's given the time frame, I think we've had a ton of information packed into the last hour and a half, which is really, really great. And looking forward, the prospects look very, very positive. So I'm excited about it. Rob, did you want to add anything more to that?
I was just going to put forward a note of thanks and notes of reminder to look for the MRB invitation. And we hope that you can make it to the telehealth, health-related conference next week on the 19th. So we thank you very much.
All right. Sounds good, guys. And we'll talk soon, and everyone have a great day.
Thanks, everybody.
Take care.
Thank you, guys.
Thank you.
Thanks.